Right. What we're looking for now is the buy right and the covered call, basically the same thing. Covered call is more of a protection, and buy right is basically doing it at the same time. So, in other words, if I have stock in Starbucks and I'm thinking I want to generate some income, I would sell a call against my stock, and stock's going at 50, sell a call at 52, generate $2 or $200 roughly, depending on the situation. But that's a covered call. And basically, it'll be a month, 2 months out, and then I'll get, when the options expire, I get all that money. The buy right is something, or what we're doing here is mainly the hold for one day. Now, basically, you can use calls and puts, but we're going to just do a call. And we're going to long on the stock. So, basically, what we do, here's an example: Starbucks. So I scanned it the same way I scanned the last video, and I showed you how you can find these for free, just using bar chart. So same thing. This is how I found this one. Went to bar chart, did the scan for a high implied volatility, and it was expiring in a couple of days. So I did this on Wednesday, found this, and then looked at this trade for Thursday to close out on Friday, or have it self-close on Friday night. So let's look at this. Now, Starbucks is trading at $57.56. So what I'm going to do is buy that. So $57.56 times 100, so $5,756. And now I have to, and at the same time, simultaneously, I am going to find an option to sell against it. So on this case, I can do the 57.50 since it's right at the money. Actually, it's kind of in the money by 6 cents. As you can see on the 57.50 strike price, I will make $1.08. $1.08 times 100 is $108. That's commission, of course. But the $58 just going out just 50 cents, I'm going to get $82. So this is basically, depending on the strategy you want to use, or how you feel about it, you can go with this. But again, the 57, if you're just looking for straight income, remember, you're only holding this for one day. So it's not like this is a month, money's tied up for a month. You're keeping your money moving. And that's what I really love about this strategy. We're doing it on Thursday, um, to close on the following Friday. Now, let's so basically, let's see what happened on this trade. So let's do the simple math on this. Um, your account, your whatever your broker is, actually has a tool. So you just click, and it just gives you these answers without you having to use the math. So you don't have to do the math, but I like to show the math so you know exactly what's behind the information that that the broker is giving you. So on this particular, if you're doing a 1 day, 30 days, 15 days, or whatever, the math will change. But I'm going to show you the 1 day calculation. So 1 day, we take the stock price times the implied volatility. So the stock price times the implied volatility of the strike price we're going to use. Divide that by 15.87. 15.87 is 256 trading days squared. 15.87. And you'll find is that once you get into options and start looking at the pricing models, and even a lot of the technical analysis, you'll find that the square root is a huge part of it. It's always going to be in there. It's part of all the math. I mean, just think of it as the duct tape of all financial mathematics. Okay. Now, so Starbucks is at 57.56 times the 79.06, which is implied volatility. See over here, 57.50, and then if we go to the far left, we'll see implied volatility. The IV is 79.06, 76.52, and so forth. It gives us $2.80 or 2.86. Now 2.86 or $2.86 plus 57.56. So we're basically stating that this in 1 day could shoot up to $60.15 based on implied volatility. Now there's what they call, there's an old saying that says, we write, damn right, and statistics, lies, more lies, and statistics. So basically, statistically speaking, this stock should get to $60.42. But what happens Thursday night, implied volatility breaks down. So that 0.7962 volatility will break down to 30 or 20. So it's not going to be a big move because that's just the way implied volatility works, and we'll do that when I do the Greeks in another video. But so there's Starbucks, 286, and then if you're on the short side, 54.70. The reason I wanted to show you this is that this is basically saying what it could do, but there's other indicators that we're going to use. Now, Friday options expiration day. Here's what happened to Starbucks. As you can see, it got down from the day before and to about 57.20. Then throughout the day, again, you're at work. You really don't care about this. It's the safest, one of the safest. I mean, option trading is not, 100% safe, or nothing's really safe and principal protected, but this is the safest thing that you can do because your only risk is you'll inherit the stock. You'll have to keep the stock, or which is fine, or the stock gets what is the taken away, not taken away, but exercised away from you. So it's not really, so Friday you're at work, you really don't care. It's either you still own Starbucks and you still got some money, or it was exercised away and you got a little bit more money plus the money you received in premium. So 57.90 at close. So basically, depending on what strategy you use, if you did the at the money or out of the money, you're still fine. You made either $108 and that was it, or you made the 80 plus the 25 because you went out of the money. Now let's see this on some others. Now this is AMD. I think it's a advanced micro devices. As you can see again, um, I don't think I showed you this the first time, but it's 5:03:41. 5 hours, 30 minutes, and 41 seconds till the market closes. 1 day left. So I can buy AMD for $5.27, $527, and I can sell the $5 option at 42. So I inherit 42, but I bought it at 527. So um, very little money there. Well, it seems like a little money, but when you actually calculate, it's pretty big. Less commission. So now, or the $5, take the 527 and sell the 550, which I received 19 cents, $19. And again, when you're looking at this, someone looks at it as $19, 19 cents. Basically, there's two things you need to figure out. Number one, this is a 1 day option. So if you're successful with this 1 day option, you make this amount of money. You have to ask yourself, if I had $527 in the bank, how much interest did I make in 1 day? Okay, and this is the reason you trade stocks and options or invest in the stock market is because you want a better return than what the banks will give you. You want a better return than what the bond market will give you. And this is what you're doing. So again, this is 1 day. So if you're able to do this once a week for 4 weeks, you can kind of count it up and see how you can use this $500 over and over again. It's sort of like milking a cow. Let's look at another one here. American Airlines, same thing. So as you can see, 1 day to go. It is at $35.23. We buy that strike. We buy that. We sell the 35.50 for $57, for 57 cents, which is $57. Not bad for a $3,500 investment. Remember, we're still what we ended up doing was the buy right. Let's go to the next one. Or you can do the 37 out of the money. If you wanted to go out to the following week, same thing. You could have bought it at 523 and sold the 550 for 89. So you're going to hold it for an extra 8 days, or extra 7 days than on the first one, but you see you did collect a little bit more premium. And of course, on both of these, American Airlines, actually ended up jumping to 36.20, I believe. It was around about their earnings date. So that's that. Now, there you go. There's your Wall Street Money Machine. I hope you enjoyed the video. Please subscribe or share.